Where would you be if our country faced double or even triple digit inflation? Most people would not be prepared. However, that scenario is more likely than you may think. My name is Jim Kirby. I'm a certified public accountant and a certified financial planner. In this 10-minute video, I will explain why we are in a unique moment in history and how that may lead to very high inflation. That will not be good for the stock market, the bond market, or real estate investments. I will also tell you how you can protect your money if you agree high inflation is coming. In this video, I will discuss some of the facts that have convinced me that our country will soon face a financial crisis. My hope is that you use this information to protect your hard-earned assets from the coming financial crisis.
This is the Fed balance sheet. In 2008, it was $800 billion. Today, it is over $4.3 trillion. That's over 5 times the amount that it was in 2008 and an increase of over 400%. In the year 2013 alone, the Fed balance sheet increased by over $1 trillion, which exceeded all of the money that was printed during the first 95 years of the Fed's existence from 1914 to 2008. Should we be concerned about the expanding money supply? In 1995, the Federal Reserve Bank of Minneapolis conducted a study of 110 countries which had experienced high inflation between 1960 and 1990. Their study concluded that there is a high correlation between the rate of growth of the money supply and the rate of inflation. The study went on to say that the correlation is very close to linear, meaning that since we have had a 400% increase in our money supply, we should expect 400% inflation. Alan Greenspan was the former Fed chairman for 19 years between 1987 and 2006. Last year, he said, we have at this particular stage a fiat money, which is essentially money printed by a government. Some mechanism has got to be in place that restricts the amount of money which is produced, because unless you do that, all of history suggests that inflation will take hold with very deleterious effects on economic activity. David Wiedemer, who has a PhD in economics, Robert Wiedemer, and Cindy Spitzer were some of the few who saw the 2008 collapse of the real estate market coming. In 2004, 4 years before the collapse, they began writing a book, America's Bubble Economy, which was published in 2006. That book predicted the collapse of the real estate market and the stock market. In 2011, they published Aftershock Second Edition. In Aftershock Second Edition, they predict that in the next few years, the government will no longer be able to refinance its debt. Its first action will be to make up the difference between spending and the tax revenues it takes in by massively increasing the money supply and creating multi-100% annual inflation. They predict that this will begin sometime between 2013 and 2015. Now, you might have considered this prediction an exaggeration if I had not cited foremost experts who have reached the same conclusion. Hopefully, you realize that this is not an exaggeration, since the former Fed chairman, Alan Greenspan, and the Federal Reserve Bank of Minneapolis have arrived at similar conclusions. Other predictions Aftershock Second Edition makes are that Social Security will become means-tested, making Social Security essentially a welfare program. Tax rates on the average working individual could rise as high as 50%. Unemployment will be much higher, likely in the 40 to 60% range. If unemployment is in the 40 to 60% range, GDP would drop by a similar amount. If GDP drops by 50%, half the businesses in the United States would close their doors. Stocks, bonds, and real estate will plunge in value. So how do you invest? Investments that have historically done well in an inflationary environment are precious metals such as gold, platinum, and silver, certain commodities, bear funds, which are funds that provide higher returns when the market declines, and certain foreign currencies. Besides changing your investments, Aftershock Second Edition recommends paying off your credit cards and revolving debt, but don't pay off so much debt that you leave yourself with little savings. Keep your student loans current to maintain your credit score. Reduce your spending. And don't retire, hang on to your job. There are three groups of people: those who don't see the financial crisis coming and don't prepare, those who hear about the financial crisis and don't prepare, and those who hear about the financial crisis and prepare. Ask yourself which group you will be in. Now, why would someone hear about the financial crisis and not prepare? The most likely reason is normalcy bias. Normalcy bias refers to a mental state people enter when facing a disaster. It causes people to underestimate both the possibility of a disaster occurring and its possible effects. This may result in situations where people fail to adequately prepare for a disaster. The assumption is that since the disaster has never occurred, then it never will occur. People with a normalcy bias have difficulty reacting to something they have not experienced before. They also tend to interpret warnings in the most optimistic way possible, seizing on any ambiguities to infer a less serious situation. Some examples of normalcy bias are the Holocaust, where millions of Jews died because they did not take Hitler's threats seriously and leave Germany while he could; 9/11, where the CIA had warned the White House that an al-Qaeda attack was likely and that there could be mass casualties; Hurricane Katrina, where FEMA studies had warned that a direct hurricane strike on New Orleans could lead to massive flooding and thousands of deaths; and the nuclear disaster at Fukushima, where geological evidence showed that there were 3 major tsunamis there in the last 3,000 years. This cartoon shows lemmings going over a cliff. One of the little lemmings approaching the cliff says, "Wait a minute, something feels wrong." Ask yourself, at what point will something feel wrong to you? If something feels wrong to you now, call us at 714-203-8900 to schedule a free meeting to talk about how to protect your hard-earned, hard-saved money. There is no charge and there is no obligation. You may also want to visit our website to view other presentations on our snowballing national debt and our overpriced stock market. Now for the disclosures. This seminar discusses some of the long-term consequences our country may face if we experience very high inflation. It contains forward-looking statements. It is never possible, however, for anyone to predict the future of the economy. Nevertheless, inflation and other dangers discussed in the seminar are legitimate concerns. This seminar is intended for educational purposes only. The opinions included do not constitute investment advice or a recommendation to buy or sell a security, and past performance is not a guarantee of future results.